the economic bubble and the Great Depression. Two renowned economists, writing for the Wall Street Journal, claim that the Great Depression and the current economic crisis are eerily similar. In each instance, the financial system has been virtually crippled by absorbing huge sums of consumer debt. Stephen Gjerstad, a visiting research associate at Chapman University, and Vernon Smith, a professor of economics at Chapman and 2002 Nobel laureate in economics, write that the parallels between then and now are numerous. Over the past decade, the American people have been consumed with mortgage debt, very similar to the situation in 1929, when mortgages held up over 27% of household wealth. Just as then, the housing bubble, which began in 1997, has witnessed an explosion of home ownership and consumer debt, all of it fueled by government policy. Gjerstad and Smith wrote that monetary policy, mortgage finance, relaxed lending standards, and tax-free capital gains provided astonishing economic stimulus. And during this housing boom, the Federal Reserve actually took steps to expand the bubble, as opposed to its contractionary policies in 1979 and 1989, as well as points in its history, when it stood as a safeguard against rampant inflation. Instead of pushing back against the bubble, the Fed increased the flow of money, making borrowing even easier and creating the conditions for the subprime market, which was the first in a long line of financial industries to go bust. When those initial loans turned sour, the financial institutions were left to foot the bill on the defaulted mortgages. In 2006, as loan defaults began to increase, the balance sheets of banks across the country began to take serious hits. Borrowers faced foreclosure because their income could not keep up with their house payments, and banks faced collapse as costly foreclosures began replacing profitable payment schedules. Accounting write-downs soared into the billions as everything which had been driven by housing gains, the stock market, private investment, home equity, indeed the entire financial industry, began taking huge hits. Credit and lending collapsed under the weight of institutional write-downs, and consumer spending took a serious hit as banks and other financiers began refusing almost all of their previous customers. To correct the problem, the government began pouring money into institutions with the hope that they would lend that money out. But in actuality, all they're doing is hoarding the money, paying their own executives, and hoping for more. During the Great Depression, the remaining losses had to be absorbed by the financial system. Unfortunately, right now, we're not allowing the system to absorb its own losses. We keep hearing that we must save the finance industry, but we do so while completely ignoring the purging fires of the Great Depression. The government during the 1930s put strong regulations in place and let everyone who couldn't meet the new standards fail. The government today is putting loophole regulations in place and catering to the rich and powerful institutions instead of doing what is best for this country. The housing bubble which created this downturn is eerily similar to the one which created the Great Depression, but the approaches to solving this problem are perplexingly different. Instead of doing something that was proven to work, the government is creating new policies on the fly. Even with a major concerted governmental effort on every level, the Great Depression went on for 10 full years and was only halted by the outbreak of World War II. This time around, we may be falling down a much deeper hole, one which requires a longer time to dig ourselves out. On behalf of concerned citizens, I'm Craig Harrington. For more on this and other related topics, please log on to economyincrisis.org.
Wake up, America! Open up your eyes! Wake up, America! Wake up!
Produced by economyincrisis.org.